All right, so today, as promised last time, we're going to go over financial statements, which you already know about from 210 and even the Introduction to Business course. 330, a lot of classes cover these. So I'm just giving a reinforcement of this material because in investing, it's critical to understand what's a strong balance sheet, what's an improving income statement, how these relate to changes in stock prices. And it turns out that financial metrics have a great deal of influence on stock prices. And earnings season is just starting, and as different companies that you may have in the virtual stock market begin to release earnings, the stocks can move quite quickly based on the earnings release. So if the earnings release is better than expected, the stock price will go up. If the earnings release is worse than expected, the stock price will go down. And that's pretty much common sense. Things we look for in the press releases are, different industries have different things you want to look at. Retail is very much year-over-year sales at their stores. Some companies you want to monitor their inventory, their backlog. Backlog is like a list of customers who placed orders that aren't filled yet. And like in defense industry, their backlog is important because they could take 6 months to a year to fill some of the orders. They order a new jet plane or tank. Those aren't built overnight. And in some other industries, you may want to look at the breakup of the income. Where is the income coming from? So if maybe you're looking at Apple, you want to know, okay, where is Apple making their income? Which product segment? Where are they losing money? In some cases, a company could have a good financial result based on winning a lawsuit or an unexpected tax gain. So that has nothing to do with operations. So if the operations are deteriorating, it may be masked by some sort of other financial surprise. So that's why you want to look in a little bit more closely as to what's occurring. All right. Okay, so the basic of any company is assets, liabilities, and equity. And that's just sort of a summary of where the company stands. If you take all your assets, subtract out your liabilities, this is the equity left in the company. Just like if you have a car and you have a car loan, car is worth $20,000, your car loan is $15,000, your equity in that car is $5,000. So if you sold that car for $20,000, you'd have $5,000 profit after you paid off your loan. It's the same thing when you're looking at companies. That's just a real micro level. This is an example of a balance sheet, and as you know, the assets come first, and it's listed from the most current to longer-term assets, and then you have your liabilities, again listed from the most current liabilities to the longer-term liabilities, and then you have your equity, which is basically liabilities and equity together equal the assets. So any assets broken up between equity and liability. So maybe you probably don't own a house, but maybe your parents do. And your parents have a certain amount of, if the house was a balance sheet, you would say, okay, the house is the asset that's worth $500,000. We still have a loan on it for $300,000. So the equity we have is $200,000. The $200,000 of equity plus the $300,000 loan equals the $500,000 asset. So what if the housing value goes down by $100,000? The loan doesn't change, your equity changes. So if the housing value went down by $100,000, your loan's still $300,000, but now your equity is only $100,000. And that's the same thing in the stock market. If the stock price goes up or down, that changes the equity segment of the balance sheet. All right. And the biggest thing in the equity section is there's two big things. It's the common shares, that equity, and then there's also the retained earnings. And the retained earnings is money that the company makes that they choose to reinvest in the company. So the company makes profits, and they can either pay them out as a dividend or retain the earnings and reinvest them. Buy a new company. Buy a new company. Expand the current company. Maybe you're Dunkin' Donuts, you make a lot of profits, then you open 2,000 locations in the West, but they don't have coverage currently, doubling the size and the revenues and the sales and profits of the company. But unfortunately, that would have to be a lot of profits to do that, or a lot of capital. And when you talk about, franchising or expanding a current brand like Dunkin' Donuts, you want to do it multiple stores at a time. So you can get, so the advertising is a little bit more effective. So if you have 20 locations in one county, then you can advertise in the paper, in the Penny Saver, and local radio, and get a lot more bang for your buck. If you just have one location, it's not, you're only, whatever advertising you do only goes to benefit that one location. So a lot of times when they want to come into an area, they want to open multiple locations. They rather open multiple locations in one area than, one location in every state. They rather have 20 locations in New York rather than one location in 20 states on the eastern seaboard, because that's how they do it in pockets. Just common business sense. Now, the income statement: revenues, expenses, and profits. You have your revenues from sales, your expenses from operating the business, and then your leftover profits. In the finance class, when we do the simulation, a lot of people are good at expanding their revenues, but they don't focus on increasing their profits. And I always use the example: what would you rather have? A company that has $5 billion in sales or $5 million in sales? Most people say, well, $5 billion. But then I tell you, okay, the company that has $5 billion in sales is the post office, and it has $2 billion loss. The company that has $5 million in sales is some online internet company, and it has $4 million in profits. Now, which company would you rather own? You see, it's about the profits, not necessarily the revenues. So when you look at, but you can't really have profits without revenues. So you like a company that has both expanding and generous revenues with good profit margins. And you want both of them to increase at the same time. You want sales to increase as well as profit margins. In some cases, in some industries, when you're analyzing them, if they can increase sales, that makes their fixed costs lower, and it makes their expenses lower. So they could really, if they had a fixed cost of research development of a particular drug, but they can sell that drug to everybody. Maybe it's a drug that stops aging. So you take this one pill a day and your body never ages. Wouldn't everybody want to take that? So whatever that massive research development cost was, if you can amortize it over billions of sales, it's a very small fraction of every sale, rather than if you created a drug that solves a small problem. And that's why a lot of drug companies, they don't really want to work on the small problems. They want to work on the bigger types of issues. That's why they rather work on something like cholesterol, high blood pressure, diabetic pills, because there's a lot of people who take that, rather than really small niche areas, unless they have separate government funding. Okay, so in the income statement, we're looking at a relationship between expenses and revenues. We don't want expenses to grow faster than revenues. So if an example of growing, revenues, if revenues are flat and you're giving everybody a raise, now your expenses are growing faster than your revenues. So companies have to keep that in proportion. So a lot of companies, if you get a job and you're working for a company, and you don't get a big raise, one excuse the company can use is, hey, our revenues haven't increased, our profits haven't increased, we really can't afford to increase our expenses, so we're laying you off. Glad you asked that question now? And then you're like, wow, I should have just kept my mouth shut. And we also want to look at, in the income statement, it's very important to look at the trends. Is there upward trend in revenues? Is there upward trend in profits, rather than a downward trend? So we want to know where things are going. Just like if you were to go to graduate school, people would look at your transcript, and they want to know, are you going from C's to A's or A's to C's? Because they want to see an upward trajectory in your abilities. And this is just a basic income statement. And again, if you did, you should be familiar with this from the other business classes. And it's a pretty basic concept. You start out with your revenues, you take away your cost of goods, which are materials and labor. Then you have a gross profit. You take away your operating costs, which are buildings, equipment, non-direct personnel, people who don't directly work on the product. People like you won't get your hands dirty with the product. You're working human resources, accounting or finance or sales or management. So you'll be in the operational part. Take away those operational and selling expenses, advertising, and things like that. And then you have your operating income. Take away your interest and taxes, and then you have your net income. And then that, from your net income, you can pay out dividends or retain those earnings. So, now, for investing, we're also really interested in this third financial statement that you may not actually have a lot of experience with, and it's the statement of cash flows. And I know that at least when I teach the finance class, I go over this in good detail. In the statement of cash flows, we're looking at how a company manages and receives their cash. Okay? So if I give you an example on a personal level, you have these, we'll use you two as my examples. Okay? So these two girls here, they both have a brand new house, new car, nice clothes, nice jewelry, nice shoes, brand new furniture. What else would you like to own or have? Anything else? New dishes? Anything? Your heart's desire. All right, so both these girls seem to have it all. Everything brand new and nice, expensive cars. She drives an Audi. You have a BMW. In fact, you have two cars. You have like a truck just in case you need to go to Costco to pick up some bulk items. And you have a nice backyard and all the fine touches on your home. So if you look at these two girls, both of them, you'd say, wow, they're doing pretty well. They've got the American dream. However, if you look a little bit closer, you would find that you purchased everything. You had a trust fund, and you have a big job, and you bought everything in cash, so everything's paid for. You had aggressively borrowed money and credit cards and bank loans and financing, so everything you have is sort of purchase on credit. You didn't pay $1 for anything. Who is in a stronger financial position? Obviously, the person who's paid everything off or paid everything with cash. So they may, from the surface, they both may look like, they have a lot and there's a lot, they're wealthy and rich. But if you look beneath the surface, how is that funded? And that's what the cash flow sort of looks at, is where you got all your cash from borrowing and you bought a lot of enough stuff with that. Don't feel bad about that. That's what the average American does. You got everything from paying cash because you don't believe in debt. You just don't want to have anything to do with it. So your cash would come from investments and income that you earned, and your cash is coming from financing. So companies can do the same thing. They can get their capital, we call the cash capital in companies, from their business, from their investments, and they could use that money for their cash inflows to expand the business or just save it. Other businesses just borrow everything. They're highly leveraged. When these venture capital groups come out and they buy other companies, they're leveraging them. Everything is debt. And we would say they don't really have a strong income statement or balance sheet if everything is debt. So we want to know exactly where their cash is coming from and how they're using it. And that's what the statement of cash flows tell us. And we like to look at a business that has what we call a positive cash flow operationally. Yes? No, that's investing for you personally. We're talking about company balance sheets. It does work for companies. But for a company, if you're an investor, you'd rather have a company that has a lower amount of debt than a higher amount of debt. It's much safer, because if a company has a high amount of debt, they have more financial risk. They could go bankrupt more easily. The more debt they take on, the riskier the company is. So it's sort of a balance. You want a company that borrows enough that's within industry norms and which is enough that they can afford. You don't want them to become highly leveraged or a leveraged company that has so much debt, one little downturn in the company's sales or profits is going to leave them bankrupt. And the cash flow statement really gives us a good idea of where the cash is coming from. Now, if you're a company that has a great idea, I read about this company that made this new battery that could last a long time and it can be up for a month before you need to recharge it, and recharges in like 20 minutes or something like that. You heard this story? No, of course, you don't read the news. And also a new organic solar panel that's up to 90% efficient. So if I had either of those two products in development that look like they're going to work out as real products, I would want to take a lot of debt to build a factory to start making those products because I know they're going to sell and make my company wildly profitable in the future. But if I had another product that was, not as promising, as revolutionary, or not as big of a game changer, or as disruptive, I may be a little bit more cautious about how aggressive I get rolling out or expanding production and sales of that. So a lot of times you have to take in coordination with the cash flow statement, what's the potential of this company? Is it a sure thing? Then you can not worry so much about the debt if it's a sure thing. For example, some companies that have a very reliable stream of revenues can borrow more money and not be as penalized for it. Say a company like McDonald's, they can borrow aggressively and it really won't even change the matter of the stock. But there could be a new company that's much smaller, and their less proven revenue streams or cash streams would be more difficult. You would discount those companies. So before you buy a company, you should be a little bit more familiar where are they getting their cash? And you want companies to get their cash from generating it from operations, mostly. That they're self-sufficient, they're making, there's some companies that can show a gross profit but a net loss because their operations are sucking up all of their profits. Well, who would want to buy debt? Yeah, that would be fraud. If the company really legitimately owes those debts, no one is going to relieve a company of their obligation of debt. That debt is not something you want to buy. Like, I'm not going to buy your credit card debt. They could repackage their debt and maybe at a lower interest rate, but no bank is going to assume the responsibility of another company's debt and then pay them for it. That doesn't. I think you might be thinking of a different type of scenario that kind of seems like that, but it isn't. An off-balance sheet type of trickery that companies used to do that they've made a lot of regulations against to prevent companies from moving debt off balance sheet, because that is fraud. If the company owes this money, it has to be it should be reflective in their balance sheet. But in the past, companies have done tricky things to make it seem like they don't own that debt, like having a holding company and placing the debt on a holding company and pretending like they're not associated with that holding company, and that is fraud. And one thing we're very interested in is the liquidity of the company. Basically, how much cash does the company have to afford their debts? And being a college student, you may be someone that just has enough money to get by, just enough money to pay your bills and your life while you're going to college, not someone who has an ample amount of cash, more than what you are currently spending or owe. And for companies that live in that situation, it's risky. They don't have a lot of liquidity. One problem or hiccup, and they can go bankrupt. And that's why these companies, when the economy goes into a recession, a lot of these companies do go bankrupt because they're leveraged to the max. And that's just poor financial planning. And here in the cash flow statement, you could see that up here, we have cash flow from operations, and this is where we want to have a positive cash flow from the actual running of the business. Cash flow from financing activities, this is borrowing money or paying money back. And then cash flow from investing is the second area, and that's from actually companies can make investments in other companies. They can put money in accounts or bonds or even stock. Where is my cursor now? Here it is. And then the last one is the cash flow from financing activities. This is the borrowing of money. So you would, for any company, some companies are sometimes purchased. They may be in a bankruptcy mode. Do you remember this product called Twinkies? Hostess. Well, that company went bankrupt. But the operations of the company, the products of the company operationally are still valuable. So other companies purchased different segments of this company and are now making Twinkies themselves. What happened with this Hostess company is that their expenses of operating their business, their distribution, paying their union employees, paying a lot of salaries for upper management that they didn't need. It was just a very inefficient business, and they just kept borrowing money to fill in the gaps so they could keep moving along. And that might work for the post office that's going to be supported by the U.S. government, but it does not work for a private company, or they were public at the time. So eventually, they just got to a point where no one would lend them any more money, and they couldn't pay off their debt, and they were bankrupt. And they went to bankruptcy court, and then certain assets of the company were sold, and that's why there was a disruption in the making of Hostess cupcakes and Twinkies for a couple of months until somebody else bought that asset and then is now making that product at a very profitable rate because they don't have the same overhead as Hostess. No, it's printed on the box. Yeah. It's pretty much, it's just it's not really the recipe, it's the manufacturing process. Because it's just yellow sponge cake with cream frosting in the middle. It's not, what you're buying is not so much the recipe, because you could easily, with today's equipment, you can easily reverse engineer what's inside a Twinkie. No one has a secret formula, because we have the spectrometers that, I worked in the vitamin industry, we would take other people's vitamins and put them on the spectrometer, and we would figure out exactly what was in it. And we found that if you're taking Centrum, there's almost no nutritional value in those compared to what they say they have. You can do that for Coke. Yeah. The whole secret recipe for Coke is just for you stupid consumers who don't know any better. But it's easy enough to find out what's in there. It's not so secret. But companies have a brand, and that's what's valuable, the Twinkie brand. So, and over the years, there have been plenty of other companies that made knockoffs of these products, and you can do that. It's sponge cake with cream inside. It's not it's not like what's really protected is the brand and the image, not so much what and if you look at the new Twinkies are a little bit different. They're definitely smaller, and they have been switching out ingredients over the years. They got rid of the trans fats, and they make them with, I think without trans fats now. Things taste better with trans fats. Okay, but that's a good question. So cash flows are very important statements. Now, to get these financial statements, certainly the company's website will release the financial statements or have them stored. There are, plenty of government. There's one, sec.gov. Plenty of websites out here that will give you the financial statements, including Hoover's that you have access to. Even Yahoo Finance, any of these, you can get the financial statements quite easily for any of these companies. I usually just use Hoover's or even Yahoo. I get a quick financial statement to get an idea. But the financial statements are tedious, and they're hard to compare different size companies. So financial ratios are really the shortcut to calculating these. I'm going to hold on to that. So if we want to look at a relationship between the income statement, balance sheet, and cash flows, and make companies comparable to each other, financial ratios are sort of a shortcut for that. It sort of breaks down and makes the financial statements interpretable in a much quicker fashion. And in the slide here, it's just sort of like an X-rays of the financial relationships in the financial statements, and you can easily see the trends. Look how companies compare within the industry. So financial ratios are what financial analysts use primarily. Although if you're say a mutual fund manager, you may start with the financial ratios, but you would probably want to verify with the financial statements. So if a company has 50% growth in earnings, you may want to say exactly where is that growth coming from, where are those earnings coming from. So you do, if you're a professional investor or an institutional investor, you will have to confirm things on the income statement, balance sheet, cash flows, because they can, manipulate financial ratios through certain things they can do in the financial statements. So it's always a good idea to check the financial statements if you suspect anything's too good to be true. All right. I was reading this news story that someone bought this house in Texas. That was a really great price. But then soon after, they found out it was infested with poisonous spiders. There was estimated to be 3,000 to 4,500 of these poisonous spiders inside the walls of this house. Yeah, so they sued the previous owners who sold it to them for not disclosing it, and then but they were bankrupt already, so they had to leave the house, and they foreclosed in the house, and the bank now owns it because they just couldn't get rid of this. Who wants to live in a house with poisonous spiders? No, they saw them dropping from the ceiling or crawling out of the walls, and they recognized. In Texas, if you live in Texas, you get to know what's what with the poisonous insects. If you live in Long Island, you don't worry about it because nothing's poisonous here. The worst thing you get is like a bee sting. I guess, I hope. Mosquito bite. What's that? Oh, because when you buy a house, you only get to look at it a few times. You don't get to spend hours in there. And I'm sure before they came over, they'd kill everything and make it look clean or whatever. And then you just don't notice these little things until you're actually living in the house. And maybe they were just the unlucky ones who didn't notice it. Maybe a lot of other people did notice it and they didn't buy it. And they just happened to not notice it until it was too late. Right? No one likes to wake up and have a scorpion in their slipper. That happens in Arizona sometimes. He had the obligation to disclose that. Mm-hmm. That's why they sued him. If the house has a huge problem or issue they're trying to cover up when they sell it, they're obligated to disclose it. You can sue over that, definitely. The housing inspectors is a joke. They just rip you off. In fact, I bought properties and I just did the housing inspecting myself because the housing inspectors come over. You get this doofus that comes in. They don't know crap, and they charge you $1,500, and all they do is look around the house and do a couple stupid tests in a few sockets. It's all stuff you can easily do. They have no accountability if the home inspector messes up or. Right. If a bank's involved, they're going to require that and different things. That's why the bank gets involved. But if you're buying a property for cash, then you could just do it yourself. Like if you're going to buy a co-op or a condo or something that's not that expensive, not like if it's a whole house, you may want to definitely have a housing inspector. But if it's just some properties, you really don't need it. You can go and test the sinks and the outlets yourself easily and inspect the roof, the ceiling. But a lot of these guys, everyone I've ever talked to that had these housing inspectors come in and use them, they've never found the important stuff out. And I've seen them do it. They're so lazy. They just go over things that you could easily do yourself, and they don't care. They just want to get that easy money and leave. It's just one of the extra expenses. You can't just buy a house. It's like, okay, you have to have a lawyer, you have to have a home inspector, you have to have, if the bank's involved, they have a whole bunch of other criteria and fees and costs. So when you buy a house, $10,000 to $20,000 just disappears into this other area that has nothing to do with the actual ownership of the house. That's why buying a house is so. You don't want to keep buying houses or changing houses. It's so expensive every time you do go into it. But I digress. Let's get back to the financial ratios. Okay, so liquidity ratios. This is really sort of what we're talking about, how liquid somebody is, how much cash they have compared to their debts. So the more liquid you are, the easier it is to finance your problems. So if you make enough money, you don't worry about your credit card bill. You don't worry about I have to fix my car. You just have enough cash to do everything you want and then plenty left over at the end of the month. That's what we all want to get to, that point where we're not really have to be so strictly on a budget. We just have enough money for what we need to do, and we don't really have to track our money too closely. That's an ideal position for anybody, right? Unlike most of you guys who are in college, you probably do have to track your meal points. Otherwise, you're at the end of the semester running around the dorm. You go, got meal points? Got some meal points? Need meal points. Can you front me some meal points today? I'm starving. I'm out. Or you have the worst situation where you have too many meal points and they're going to expire and you lose that money. And you're just like, hey, anybody want to have a party on my meal points? Right? If you get the super gold rip you off plan, that you have to get these plans, right? When you're a freshman. Yeah, we don't want you to starve. Although nutritionally you could starve on campus because there's not a lot of good choices, right? Activity ratios are looking at managing the assets. How good do a company manage the assets? Here's an example of a bad management of assets. You have a laundromat, but you're only open on Sundays from noon to 3 p.m. and you're closed the rest of the week. That's a poor management of that asset. That asset should be open 24 hours a day, 7 days a week. Because you could get a lot more business, a lot more sales if you're open for a longer period of time. Basic common sense. If you have certain assets, how well are they being managed and utilized? If you have a store and the store is not stocking everything efficiently and you have a lot of stockouts and people aren't getting their sales and going to a competitor, that store is not being managed efficiently. So it's really about looking at these activity ratios, see how inventory and assets and are being managed to make sure the business is optimal. Do you ever notice that ever go to get Ralph's Ices and then you go there one day in January and it's closed? Because they found that it's more effective to manage those assets of that store to close during the cold months because they make so little money compared to the huge operational costs and then reopen in the summer months where there's a line around the block. Ever see that one on Stony Brook Road over here? And I drive by all the time. I always see like 5, 6, 10 people waiting for their... I'm like, well, what? It's just Ices. I don't understand why it's so popular. Are they that good? I've never had one. Is that good? Maybe I should get one today after school. What's the best flavor? Lemon? All right. I'll just stick with cherry. Something to make my mouth nice and red. Leveraged ratios, looking at specifically the debt used by the company. Profitability ratios, which I think are the most important, is how successful the company is at creating profits. And that's really critical for the investment world, how you create profits and how much profits and how you're accelerating them. And then common stock ratios, looking at more ratios that are tied to key per share specifics. Okay, so let's go into liquidity ratios. And again here, we're looking at current assets to current liabilities. So current assets are things that are a little bit more liquid. We could use cash. The cash that the company has is a very current, very liquid asset. Then we could look at current liabilities, things like, say, a credit card statement, things that have to be paid this month. And this ratio, the higher the better. So we would like to have $10,000 in cash and only $1,000 in credit card debt. So we would have, those are only two items in this area, we'd have a current ratio of 10. But if I had $20,000 of cash and $1,000 of credit card debt, it would be 20. So you can see how the higher the number here, the more liquid the company. So the current ratio is really, now current assets can include inventory, accounts receivable, cash. And current liabilities are mostly just short-term obligations that are within less than a year that need to be paid back. There is another form of this liquidity ratio called a quick ratio, where we just take away the inventory out of current assets. Because sometimes inventory is not as liquid as it may seem, depending on what industry it is. So that's a common one that the book just doesn't go over. Net working capital, current assets minus liabilities, is the capital or money you have to work with. So for example, in a personal level, you have $10,000 a month income and $6,000 a month of financial obligations, rent, utilities, credit cards. So you have really $4,000 of working capital. So that $4,000 a month you can invest, you can buy a business, you could buy a stock. That's what we're talking about working capital. After you take the assets you have, this in that example I was just using cash, but all the assets you have minus the current assets minus the current liabilities, and what hopefully you have a positive number, and then you have a net working capital. And this is just money, capital that you can employ at a certain point. If it could be inventory, it doesn't have to be cash. But inventory is something that you can sell at a later point. I was watching that show Shark Tank. Sometimes I was watching it on CNBC. They have that on later at night. I don't watch it on Friday because I have a life. But every time these people come up and they sell their companies, they usually need money to expand their inventory or their manufacturing. And some of these, I mean, they had a company last night that was on. They made these wood frame glasses. Was the company, and they just made glasses that were out of wood frames, and they had like $700,000, $800,000 of sales, and they were looking to sell, I think, 20% of their company for $150,000. To expand their inventory. And I was like, that's a lot of equity for just so little money. And then they declined it. Did they take the deal? They might have taken the deal, but I thought maybe they're just there for advertising because it's good free advertising to get on that show. And it's good to have it recorded because I like to fast through all the BS and just get to, okay, what's the product? And then are they actually going to buy it from them? But it's a good show business-wise, especially if you're more of an entrepreneur. That's a great show to watch to get an idea of how people have started businesses and what they're doing on a small scale. And generally, what they need is more. They can't easily get financing to expand their company. They may have the opportunity and the demand for their product, but they can't get the money to build the inventory to meet the sales because people really don't like to pay for things until they get it. So that's usually a big problem with companies. So that's why these liquidity ratios are important to see if they can finance their inventory. Okay, accounts receivable turnover. We're looking at sales in relationship to accounts receivable. So if you had a business, we'll take all the way there in the back row. You look a little bored. Say, what type of business would you like to have? Okay, so you have a fast food restaurant, and say your fast food restaurant was different. You want to be a little bit different, so you tell people, listen, buy your food today and pay me a year from now. So you don't have to pay me. You have a whole year before you have to pay me for your food. So basically what it was saying, your annual sales would equal your accounts receivable. So you sold, say, $1 million worth of food, and you have $1 million on your accounts receivable. That means waiting for people to pay you. So your actual accounts receivable turnover would be 1. That's really bad. Say we take a different restaurant, fast food restaurant, and most of their sales are cash, although they do have some credit card sales. They may actually have collect all their money by the end of the month. So they would have, say they had $1.2 million in sales and $100,000 in accounts receivable. So their accounts receivable turn would be 12. Means they turn their accounts receivable over 12 times a year. So that would be more efficient. Although I do like the idea of not paying for my food for a whole year. You don't like it as a business owner because you're not getting any revenue. And that's the problem with a lot of businesses that, especially if they're bigger items, you have to sometimes sell it, loan them the money to buy it from you first, which means you basically give it to them and hope that they pay you. And there are a lot of businesses, that's how their business works. It's not retail or consumer level if you're selling from company to company. And that's really tough to get the cash you need to build all your inventory, to sell it, and hoping that they pay you at a later date, especially if you're a government contractor. It could take 6 months before you're paid from the government. And here you are making all these, whatever the battery chargers or defense systems or electronics. And I worked for a defense company, and we would make these sophisticated electronics for, say, the Tomahawk cruise missiles. And lots of millions of dollars invested in it, and we'd have to wait months and months and months to be reimbursed. It was really tight. I had to take a lot of skill managing the money of that company to keep everything afloat while we're waiting for the government to pay us. Wow. I didn't realize. I don't really know. I know basically how Groupon works. You want to put together a deal, and Groupon's going to manage it and get people into your store. I didn't realize that they paid Groupon first, and then you had to wait to be reimbursed by Groupon. Yeah, well then that's a bad deal. Yeah, I mean, sometimes if you're a business and you're desperate and Groupon is sort of a way to get noticed. Yeah. I'll tell you what Jamba Juice's problem is on the island. They're giving up, you know, they're giving up a big market in health juices because you go to like the Jamba Juice in Penn Station, they'll make you a carrot juice, they'll make you the broccoli and celery, and they make because I go to the one over here and they just have carrots and oranges. Oh, okay. All right. So that was my one area I thought that they were missing out on the island because you go to Jamba Juice in the island, it's like here's a pile of iced sugar garbage, which we call what are those things called? A smoothie or whatever. It's just real garbage for you. It's all sugar and ice, and it's horrible for you. And some other junk food, like you can't really have lunch there, or it's like oh, like why would you go there? So, but there are people who do want to have, juice cleansing and juice diets are becoming more and more popular. And it's a real pain in the ass to actually juice at home. So if they were a little bit more, there's really not anywhere you can go in Long Island to get that, unless it's a specialty nutritional store, and there's not that many. So if they're actually launching this line, do you work at the one close by? Okay. So I have a reason to stop there now. So actually things may be better for them. I'll have to look for the Groupon though first. Anybody want to go in one with me at the Groupon? No? Okay. Um, Moving on. Inventory turnover. This is looking at annual sales to inventory. So we'll go back to the back row again. And can you imagine what inventory would you need for your restaurant? Foodstuffs, right? Buns, burgers, French fries, whatever. That inventory is not only can be expensive, it also perishes. So you can't have huge amounts of inventory on hand. You can't have a year's worth of tomatoes in a refrigerator. Okay, so in a company like that, you would expect to have a high inventory turnover ratio, meaning that you would probably want to keep a week's worth of food on hand or 2 weeks worth of food on hand compared to your sales. So you may have a 26 turnover. Your inventory is only related to your sales. Every 2 weeks you get a whole new inventory. So just think of a store that you brought, even if it's you personally, you're buying your food for the week, you buy everything you need on Sunday, and by next Saturday you run out of all your food. That means your inventory would turn 52 times a year. Can you imagine if you try to buy all your food for the year on one day? All the cereal, all the milk, everything you're going to eat for a whole year, you have planned out, you go to Costco and you buy everything. Where would you store all of that? And how much of that would go bad or be stolen by your friends? Right? That happens in dorm rooms. Sometimes your friend comes over and just helps himself to your Pop-Tarts or your ramen noodles. So inventory, for a lot of businesses, you want to know how efficient they are with the inventories. When I was younger, most stores had half the store was like a back storeroom. So the front of the store, you would ask, oh, do you have any more of this? And you go in the back and they pull out another case, or they would have they'd have almost as much backup stock as they had on the shelf. And to make inventory more efficient, they said, let's stop the backup stock room. We'll just expand the store, and we'll just get deliveries more frequently. So if we run out today, we'll have new stuff delivered tomorrow. And if you look at a lot of stores, they don't have all the inventory they have is on the shelf. And they have these systems that if they run low, a new truck comes the next day and it's going to replenish. But every once in a while, they run out. It happens. But that to them, they're more worried about overstocking the inventory because that can become a financial burden to them. Because that's money, that's cash in the inventory. So if a company had a lot of inventory and it's suddenly becoming more efficient with the inventory, that's sort of like free cash. Just like if you said to yourself, I'm going to go home and not buy food for the next 2 weeks. I'm just going to eat all the stuff that I've purchased previously, but I never eat. Like that bag of rice or that, Just that food that we all have this food that builds up in our kitchens that we just never get around to eating. We just buy new food or go out to eat. And if you just said, for this next week, no new food, no going out to eat, I'm just going to live on whatever is in, so one night your dinner could be a box of croutons and an old carrot. You're just going to survive on whatever, just like, I'm not saying it would be pleasant or nutritionally sound, but you'd save a lot of money that week. Total asset turnover looks at your sales in relationship to your assets. So if you had $1 million asset, think of this big machine, and you press one button, and on the other end of it, a pizza comes out. That's your asset, this big pizza making machine. You never have to add any ingredients, though. It's a magic machine. You press a button, and a pizza comes out. So you have $1 million asset, and you sell $1 million worth of pizzas. So your total asset turnover is 1. But then one day you realize that I could sell these pizzas to supermarkets as frozen pizzas, and then you figure out, instead of running this machine for 1 hour a day, I'm going to run this machine for 12 hours. And I'm suddenly going to have $12 million worth of sales versus $1 million of assets. So it's really how you leverage your assets. And the more sales you can get out of the same level of assets, the more efficient your business is. Say for example, if you're a factory and you make your factory makes automobiles, but you only operate 8 hours a day. But there's more orders, people looking to buy more of your cars, but you can't fill them. So your choice is, these are like $1 billion factory. Make a new factory. Now you're going to have $2 billion worth of assets in 2 factories. Or take that same factory and open up a second shift and run it for 16 hours. Now you're getting twice the amount of sales with the same asset. Hell, let's make 3 shifts. There's 24 hours in a day. I can have 3 8-hour shifts. I can triple the amount of cars I can make and triple my sales, all in the same asset. And that's what a lot of companies have been doing. The airline industry is like this too. Has anybody flown on any airline? You fly in Southwest, you notice your flight comes in, you get off, there's a whole new set of people waiting to get back on that flight. And these flights go around all day to many different stops with as short a possible stopover as they can have, so they can reboard the plane and re-get that in the air. Because it's more efficient to run that. Just if you took a plane and had to just do one flight from New York to Florida and back just once a day, that wouldn't be as much profit you can generate from that plane if you took that plane from New York to Florida back and forth 4 times a day. So you can see how you could get twice the amount of sales out of that aircraft by running it more than just running it, This is just common sense. So anywhere a business or a company can look at and say, how can I get more sales out of my asset? Maybe you're someone that owns a home close to campus, and you say, a house is an asset, right? But I'm not really making any sales from my house. What do? Rent it out. Whore out your house. Announce in class that you have rooms to rent, and it's $500 a month, and you converted just about anything you can convert to a bedroom, you did, and you got 6 bedrooms in your house. That's $3,000 worth of revenue. People who live in the dorm saying, well, this is a great deal because I'm paying like over $1,000 a month to live in the dorm that I'm sharing with one room with 4 people, and here I got my home bedroom for $500. Done. When do I move in? Right? But I don't suggest you do that unless you own the house. Debt to equity ratios. We're looking at long-term debt to stockholders' equity. And long-term debt is, anything that's going to take more than a year to pay back, like a mortgage or car loan. And then stockholders' equity is the actual ownership you have in the company or business. Now, the higher this ratio, the more risk, because it represents you have more debt compared to your equity. So if you owed $500,000 on a home, right, that's your debt, $500,000 on the home, and your equity in the house is $100,000, your debt to equity is 5. So so it's a 1 to 5 relationship. If it was $1 million house, you still only had $100,000 of your money in it, and another $900,000 100,000 borrowed, your debt to equity would be a factor of 9. So that's a riskier scenario because now you only have 10% equity in the house as opposed to 20%. So we're really just looking at, if you're buying a company, how much equity do you have in relationship to the debt of the company? And preferably, you would want to have more equity than debt. You would rather own a house where, you owe $100,000 on the house, but the house is worth $500,000. So now your debt to equity ratio is like 0.2. So the smaller the better here. It's one of the few ratios where the smaller the better. And for investors, the higher this debt to equity ratio, the more riskier the company is. All right. Times interest earned. Your earnings before interest and taxes in relationship to your interest expense. Now, unfortunately, in this world, there's a number of people who overdo it with the credit cards. And you may know somebody like this who has 5 or 6 credit cards. They have all the big department credit cards, Macy's, Kohl's, Bloomingdale's. Maybe they have gas station card. They have MasterCard, Visa, American Express, and they have $80,000 of credit card debt. Could you imagine? That's not uncommon. And $80,000 of credit card debt may require you to pay $2,000 to $3,000 worth of interest a month to keep, just before, so you don't default on your credit card debt. Now, if your earnings before interest and taxes are $100,000 a month, having $3,000 of credit card interest, having $80,000 of credit card debt is bad enough, but if you look at the $3,000 worth of interest, that's not a problem. I'm making $100,000 and I don't have $3,000 worth of interest payments. That's not a problem. So, but if I was going to bring that down to $30,000, now my times interest earned is only 10. I'm making 10 times the interest obligation. What if you only made $6,000? You only have 2 times the ability to pay your interest. So that's what we're looking at here is what ability, the higher this number, the better. And what ability do companies have in their earnings to pay the interest that they're obligated to pay? And companies typically have more interest because they take out bigger loans. So a company can borrow $8, $10, $100 million. And in some companies, they'll charge interest rates as high as credit cards, depending on how risky or how small the company is. So you really want to know what's their ability to pay this debt. You never want to take on more debt. Debt is okay to have. It's not necessarily a bad thing as long as you have the funding to pay for it and more funding than you need. Okay, profitability ratios. These are very, very important for the company and for your analysis of a company. The net profit margin is probably one of the most important. It tells you after everything's done, what type of money what percentage of the sales am I going to have in my hand as profits? So, of course, higher the ratio, the better. So look at your net profits after tax in relationship to your sales or revenues. Sales and revenues are the same thing. So if you have a 10% profit margin, that's not necessarily a bad thing, but you have to compare it to the industry. Is this good on the industry average? Some industries, 10%, like the fast food industry, 10% is amazing. But in other industries like software industries, it's horrible. So it's really industry specific how you want to compare it. But you always want to be improving it because this indicator is tied to earnings per share. The earnings that you get as an investor, your net profits are critical. Now, along with net profits, so there are also operational profit margins and gross profit margins. So gross is the very top, just your sales less your costs. Operational is after that. It takes the money left over, your gross profits less your operational profits. And then to get to the net, you take your taxes and interest. So there's really 3 different profit margins. I'll talk more about that when I give the handout next week. Return on assets is looking at, that clock is fast. Return on assets, we're looking at net profit after taxes, which is basically net profits, in relationship to your assets. To kind of describe this, think of two ice cream stores. One ice cream store is old school with just a refrigerator and scoops. And just scoops things out, puts it, and then you, sort of like a Cold Stone, I guess. Everything's just scooped out of ice cream buckets. So a low amount of cost to open that store. You just need a refrigerator, some utensils, and buy the ice cream. Another store is like a Red Mango and has all these big expensive soft serve ice cream machines or frozen yogurt machines, if there's really a difference between the two. Maybe it's taste, because that's what's missing in frozen yogurt. Anyway, they may have to pay $1 million for all these machines to put in that Red Mango. If both stores have the same profit on what they sell, who's doing better? Well, the store with a smaller amount of assets. Because if I only had to spend $10,000 for the assets in my store and I have $1 million worth of sales, I'm going to be doing a lot better than someone who had to spend $1 million on ice cream machines to sell $1 million worth of ice cream. So we're really looking at that relationship. If we just look at, besides the sales, we talk about the profit. So both stores make $100,000 in profit. If you take the $100,000 related to the $10,000 of assets for the first store, that's a 10 times a 10 on the return on assets. The other store, they only get a 10%, 100,000 compared to $1 million of assets. They're only 0.10% return on assets. So you can also think of it this way. If you have $1 million to spend, you can open up one Red Mango or 10 other ice cream shops that only need, no, if you have $1 million and it only costs you $10,000 to open it, that's 100. You can open up 100 ice cream shops making $1 million a year, or one Red Mango. So that's how critical the cost of assets can become on your expansion of your company or your products. That's why we like to look at that. Okay, we have 2 minutes. We have time for one more slide. And we're going to talk about return on equity. This is a similar concept as return on assets, but here we're looking at replacing assets with equity. So we're looking at the net profits compared to your ownership. So assets minus liability give you your equity. And the equity is really the portion of the company you own, or the money you brought to the company. So if you brought $100,000 of your own personal money to a company, and that company makes $200,000 in profits, that's a good return on your equity. Doesn't matter. You may have borrowed the rest. Maybe it's $1 million to start the company. It's $100,000 of your money, $900,000 that you borrowed. At the end of the year, if the company makes $200,000, that's a pretty good return just on the $100,000 that you brought to the company's equity. As opposed to funding the company completely yourself, and it's $1 million of your cash as your equity. You own the whole company. There's no debt. You put a full $1 million of your savings into the company. Now, if it makes $200,000, your return on equity is much smaller. So having debt can actually, you're leveraging or margining, sort of like the margin, you're leveraging your investment. So you're putting very little money down and borrowing the rest. So you can maximize, just like margin in stock trading, you can maximize your returns because you're keeping your initial equity small. And you can have a much bigger investment. So it could be the factor of opening up one location versus 10. If you don't use debt, you can open up one location. If you do use debt, you can open up 10 locations. If all locations are profitable, you're going to make more money by having 10 locations rather than one. But the only way to do that is to borrow money. But it's going to result in higher profits for smaller equity, and that's what we want to look at. As long as the company isn't risky, having a higher return on equity is good. As long as the debt situation doesn't become risky, that return on equity, because that means more profits for you with less of your money having to go into the company. Okay, so we'll end here, and we'll continue the lecture next class. Have a great weekend.